All right. So good morning. Hope you're all doing well. As I mentioned, thank you all very much for following instructions and putting your full names on your screens. Absolutely wonderful. Thank you very much. There seem to be some people who have not joined on, and you know, if you're not attending classes, you're not getting class participation points. So this is all being recorded. So it's really up to you. You're grown-ups. I cannot force you to attend classes, but just understand that there are consequences. Um, Hopefully you're all keeping well and your families are all keeping well. It's kind of crazy times we all find ourselves in. As you might have seen, China is actually seems to be have recovered substantially from this coronavirus situation. So hopefully all your family members are doing well. A couple of you actually are in China already, and some of you are in quarantine there. Our thoughts and prayers are with you, and hope you all do well. And this too shall pass. All of this will actually be taken care of very soon. The bunch of you, I see your names, but I cannot see your faces. So please try to make sure your cameras are running. It doesn't look like, I see Xing's camera is running, Yunshu, your camera is running, Hongsheng, you're good. Yeah, Xing, you're good. Mavis, oh, Mavis, we have her. Mavis is actually in China. All right. Good to see you, Mavis. Hope everything is going well. All right. Our thoughts and prayers and best wishes are with you and your family. Okay. Runlin Fu, I cannot see you. Rundan, I can. Wonderful. Hanshu, I can
Professor.
see you. Chen Lu Yang, I can't. Okay. Gail Simonet, I can see you. Wonderful. Chen Lu, now I can. Let's see.
Professor,
Who are we
excuse me.
missing? Yidi, I can see you. Perfect. Jakang, I can see you. Kehan Chen, I cannot. Yishi, I cannot. Shenran, I cannot. Botao Jia, I can't. Shuohuo Ma, I cannot see you. Christine Hay, I cannot see you. Haihua Shu, I cannot see you. So please rectify, because if later on, when I ask you to put your work on Yuqing Zhao, I can see you. Great. Okay. Shohoma, wonderful. You look very serious. Everything good? Okay.
Thank you.
All right. Okay, so let's get started. We're going to do futures and forwards today. Let's get started. We have a pretty busy full plate today with a bunch of different data sets to go through as well. So let's get started. Please, as before, stop me if you have any questions and we'll go from there. You can hear me, right? Gail, can you hear me?
Yes.
Gail, can you hear me?
Oh, yes, I can hear you.
I cannot hear you.
Hi. I can hear you. My mic is on.
I've been having trouble with these speakers. Okay, Gail, can you say again?
Hi, I can hear you. Oh, probably the speakers.
Professor, could you hear me?
Okay, Gail, can you say again, please?
Hello?
Hi.
Excuse me, Professor, can you hear me?
All right.
Sorry.
Hold on for a second. I'm going to try to see if I can get another headset.
Okay.
Okay, Gail, can you speak now?
Hello.
Oh, okay, good. And you can hear me?
Yes, I can hear you.
Okay, good. It's been happening with every single video conference I've been on. There's some problem with the volume. And I think the reason is my wife and daughter, my lovely ladies, presented me with this really, really high-end laptop. I love, love, love this laptop. But the problem is it's so new, I haven't been able to figure out how the sound works on this one yet. So, so hopefully we'll, by the end of the day, these are all teething problems. Okay. All right, back to the screen. Gail, back to you. Can you see the screen?
I can see the screen.
Okay. All right. Okay, so let's continue. So forwards and futures, they're, pretty old idea. So the Futures Industry Association traces the origin of forward trading to India around 2000 BC. It's India and China are the two great ancient civilizations which still exist in this world. And it's great that we are inheritors to this great tradition. There is substantial evidence of forward markets in Greco-Roman and medieval. Okay. If you're not, Yunshu, do you have your hand up? Are you trying to say something?
No.
Okay, it's, your screen says that you have your hand upraised. Can you cancel that, please? Okay, I've lowered it.
Okay.
I've lowered it. All right.
Do you know how to cancel?
I wish I knew. I'm only a user. That's something to ask your IT people.
Okay.
But the rest of you, if you can, I'll just mute everybody and then we'll. Okay, so I've muted everybody. If you want to talk, then unmute yourself and talk, because otherwise these restrictions can be, even if you're just moving paper around, can be very distracting to the rest of the class, because that's all we're observing, that's all we're here. All right, so so futures and forward markets have been around for a long time. But in terms of actual markets where these futures are actually traded, which we'll see in a short while, is possibly the Dojima rice market in Osaka in 1730. So just kind of, because in the financial economics, it's important to understand the institutions. So if we think about today's futures markets, and they're quite active, and we'll see how futures markets are really active for things like commodities like gold or petroleum, or it's active for foreign exchange, but you don't really see futures and forwards markets that are that heavily active for equities, for instance. And later on, toward the end of this lecture, when we are kind of up to date with what's happening, I'll ask you to try to understand or explain why you think it is the case that we see futures and forwards markets in petroleum, but not so much in equities. Okay, we'll talk more about this. Okay, there's somebody sending a chat. Let me. Okay. All right. So Runlin, you're in quarantine as well. So yes, I realize as I said, a number of you are in quarantine. We will accommodate you the best we can. Please, it's great that you're doing the right thing. In fact, the governor of Maryland has called people who are in quarantine heroes for protecting your neighbors and families from this disease, and that you're quarantining yourself. It's not easy. I know my daughter is going stir crazy for a 12-year-old to be at home for such a long time, to not be able to be friends. It's really difficult. For me at my age, it's really not a problem at all. My life revolves around my wife and daughter. I'm perfectly self-contained. I'm perfectly happy to have them around me all the time. It's fabulous for me. My wife, not as much. But for our daughter who's 12 years old, who wants to be with her friends, it's very, very difficult. And for you, you're so much younger than me. And I remember when I was in my early 20s, I really wanted to be around friends, not around family, and definitely not by yourself in a quarantine hotel. So it's not easy. If there are any special circumstances you want me to explain to you, anything in particular, or you want any special consideration, please do reach out. The idea is very quite, we are going to try to do the best for everybody. Okay, on that note, I forwarded you that email from the Dean's office about the fact that all spring 2020 courses have been moved to pass-fail. But you have the right to request a letter grade, and any such request will be granted. I'm really not that familiar with the bureaucratic process of how to request a letter grade. You will have to deal with the program office for that. It's really not something I know much about. But in terms of, because at the end of the day, I will give you a grade. If you want a letter grade, I will give you a letter grade. And if it means that I don't know exactly how it's going to show up on transcripts, etc., but I will always be happy to write a letter if, for instance, you're applying to graduate school or you're applying for a job and you have an A+ in this course and you want that to show up. I'm perfectly happy to write an email saying, yes, she got an A+ in my course. I was thrilled with her performance, etc. Okay, everybody with me? So, focus on the finance. Please focus on the finance. It's easier said than done. But the rest of the distractions there are other people who can deal with them. And I definitely am not in the business of trying to be punitive, trying to punish anybody for anything. That's, I'm not the police, I'm not the judge, I'm your professor. My objective is to do the best for you, and which I will continue to do. Okay. Any questions on any of this stuff before we proceed? Because I've received a number of emails, so clearly this is something that is concerning a lot of people. Any questions? No? Okay, good. All right, as I've seen before, as I've told you before, and as I've done before, I will, this is being recorded, and I'll, all my stuff is on the cloud, so I will send you a link for this, and we will, you can check it as you can watch it as you go along. That is one of the, I think, one of the good things about this current Great Secession. We are actually able to have very high quality recordings that we can watch later. And it's actually, frankly, great for me as well, in order to track class participation. This is, far more effective than name tags and keeping track of people, what they're saying in class and so on. Once again, as you know, some of you have done phenomenally well in class. You know who you are. Come on, some smiles. Yes, I see that smile. Okay, good. Yep, good. So you know who you are. You will be getting fabulously high scores, and I would like all of you to get yes, good. I see a thumbs up. I love it. Thank you. I want all of you to learn a lot of finance. I want all of you to be able to read the news and actually have fact-based, seriously critical, thoughtful analyses of financial events. That's the objective. And if in the process you get great grades, that's even better. All right. So in today's world, the kind of, we have a very, very active futures market. And I'll talk about this in just a second, but it's the grain markets of Chicago that were significantly responsible for this. That's how they started, mostly in the US. The idea of futures, and we'll talk about this later, there's a lot of risk management involved in futures. So for instance, let's say Shuo Hua you are, let's say, a producer of wheat in the Midwest, okay? And you want to lock in a price for your product. So the way you can do it is to manage the risk by signing a futures contract where somebody is has the right and the obligation to buy your wheat from you 6 months from now at the price, let's say $100 per bushel. I'm just making up that number, but that's why it's very important for you to be able to manage that risk. In fact, one of the greatest innovations is these futures markets have done for otherwise often marginal producers. I mean, I will send you an article that I hope I'll be able to find how it has really affected, because in India, farming is a very disorganized sector. It's not large farms, it's mostly small farmers who don't necessarily have access to very well developed markets. And these futures that now they have access to has revolutionized the standard of living of who were otherwise basically marginal farmers. So these market innovations have done absolutely fantastic things for the poorest of the poor, the most vulnerable people who we as society need to protect. The financial markets, the democratization of financial markets has played a huge role in the upliftment of the very poor. And as you can see right away, the futures markets have played an amazing role in doing that. The Chicago Board of Trade, the first formalization of these grain markets was established in 1848, long time ago, and swiftly followed by a number of other exchanges. Well, if you take New York out of the picture for a second, Milwaukee, St. Louis, Kansas City, all in the Midwest. Originally, the idea of these exchanges were primarily for agriculture. And to New York, of course, the financial city, it eventually, that also happened because, there is this incredible interaction between commodities markets and financial markets. Remember one of the things that I discussed with you that when we say capital markets, we really mean from an economics perspective, anything but labor. So over 1,000 commodity exchanges sprang up in the US by the end of the 19th century. CME Group is the world's leading and most diverse marketplace. They have these 4 exchanges, the CME, the CBOT, the NYMEX, and the COMEX. But this is the very interesting aspect of this, is that the market for which we see a lot of these, as I mentioned, futures and forwards is primarily in, or the large portion of the action is in commodities. And the agricultural commodities, the markets are primarily in the US, like the CBOT and so on. For metals, it's primarily in London, okay? So like the LME, London Metal Exchange, is for industrial metals, so iron, aluminum, copper, and so on. Those futures and forwards are primarily dealt with on the London Metal Exchange, and you also have the LIFA. So there's a large variety of these futures and forwards, and I'll talk about in just a few minutes how the another large portion of activity for futures and forwards is in foreign exchange. You can see again, why is, okay, actually let's pause for a second. So let's take the risk management aspect of it. So grain, we just saw, okay, if you're a grain producer, you want to do that. Another large market for futures and forwards is commodities like metals, like iron, steel, aluminum, copper, petroleum, natural gas, and finally, foreign exchange. Do you see something in common in all of this in terms of managing risk? We have talked about it from the producer of grains perspective. Okay, Jiakang, are you there?
Yes.
Okay.
Hi, Professor.
All right, good. So thanks again, Jiakang. I love your emails. It's really good to see that you think about things. You know, it's going to work very well for you in your career, to the fact that you love to think and love to disagree. I love that. It's very important to be able to disagree. Okay, so walk us through, if you are, let's say, a steel manufacturer. Okay, you are a steel manufacturer, and what is the most important input into your production?
Maybe the raw materials.
Yes. So which raw material in particular?
Steel.
No, you're manufacturing steel. That's your output. What's the input?
Labor.
Labor, yes. What else? What are the non-labor inputs?
I think it's some other products from the producers. I'm sorry, I'm not familiar with the steel market.
You don't have to be familiar with the steel market. Kehan Chan, please, what are the, so labor is clearly a very important input in the production of steel. What are the other inputs?
Water.
Water, yes.
Electricity.
Electricity, yes. What is okay, Zhenran Wang, sorry, Zhenran Wang. What are the inputs into production of steel, in addition to the stuff that has been mentioned? Labor, water, electricity, what else?
Capital?
Maybe iron?
Yeah, exactly, iron. How is steel? What is steel? Steel is iron converted into various different things. So iron is a very important input in the production of steel. Sorry, who said iron?
It's me, Chen Lu.
Okay, Chen Lu. All right, Chen Lu, where are you? I can't see you here. Okay.
Hands up.
Okay, good, thank you. Excellent, very good. Chen, there is one more thing, and that is coal. Is another very important input in the production of steel. Now, if you are a manufacturer of steel, if you want to manage your risks, what you want to have a very good sense into the production of, all these input costs next year, right? That's a very important part of risk management. Okay, so therefore, what you would like to do, Chen Lu, is be able to have, if part of your risk management is to actually sign contracts to get water at a particular price next 6 months from now, electricity at a particular price 6 months from now, iron at a particular price 6 months from now, coal at a particular price 6 months from now. All of these inputs you would like to sign futures contracts for. The idea of a forward contract is simply, let's say you make an agreement with a supplier. Chen Lu, you are the steel manufacturer. I am a supplier of iron, and you make an agreement. Let's say I'm Anglo American. You are Rio Tinto or BHP. These are the major iron ore producers in the world, or Vale in Brazil. And you make an arrangement with me to sell you iron ore 6 months from now at $100 per ton. Actually, more like $5,000 per ton. But so I agree to do that. You agree to do that, and you have managed your risk, as in that input cost. You know exactly what it's going to be 6 months from now. Now, Now, you know that if there is a drop in price of iron ore, then you would have been better off not signing the forward contract, right? And similarly for me as the supplier, I have locked in my price, so I have managed my risk. But on the other hand, if the price had gone up 6 months from now, I would have been better off ex post not having signed the contract. Okay, so in finance, this idea of the difference between ex ante and ex post is absolutely critical. Just because something looks good ex post doesn't mean it was good ex ante, and vice versa. All right, so that's why you see these the futures and forwards contract that are very, very common in these kinds of things that are inputs into production. Okay, now let's see. Who wants to? Okay, Gail, I'm going to volunteer you. Are you there?
I'm here.
Okay, so you, let's say you own a financial services company in Bermuda. Oh, you're from the Bahamas, sorry, right?
Yes.
Yes. So you own a financial services company in the Bahamas. So as a result, a large part of your expenses are, large part of your revenues are in US dollars. Oh, sorry, what is the currency of the Bahamas?
USD. We have Bahamas dollars, but we also use USD interchangeably.
Or use interchangeably. Okay, then it's okay. Okay, it's kind of you know, in India, for instance, with the US dollar, you know, we have our own currency, but US dollars are freely accepted. All right. So a large part of your revenues, for instance, are coming. Okay, let's change the scenario a little bit. Let's say you run. I can't see you. Let me put you back on screen. Where are you? Ah, there you are. All right. So let's change the scenario a bit. Okay, you are a multinational. Let's say you're a multinational car manufacturer. Let's say you are Toyota. Okay, you do a majority of your production in Japan and Brazil and the US and some in India and China. So your costs are in all these countries. A large part of your revenues are in US dollars and in euros. So a large part of your revenues are in US dollars and euros. A large part of your costs are in Indian rupees and RMB and so on. Okay. So a large part of your profits depend on the relationship between all these currencies. All right, so put on the hat of the CEO of Toyota. What if your objective is to manage your risks? What would you like to get some certainty on? In addition to all the other inputs we talked about, you know, and for cars, it's steel, it's plastic, and of course, labor, and iron ore, rubber, all of these things are inputs into the manufacture of cars, right? So all of those things you would like to manage, of course. In addition, given the multinational nature of Toyota, what else would you like to get some certainty on?
Maybe that the exchange rates for all these currencies won't be so volatile in the future.
Exactly. Thank you very much, Gail. Exactly. You would like, particularly since those are so volatile, you would, a part of your risk management would involve signing contracts which enable you to look at, to be able to have, you know, all your revenue currencies and all your cost currencies, the relationship between them to be managed. So the part of the risk management would be to sign these forward contracts on foreign exchange rates. Okay, so so you can see how there is so much action in futures and forwards in foreign exchange. Okay. Now, one particular underlying, okay, do you understand? Okay, so we have now started a new part of the course, which is derivatives. Okay. Previously, we did equities, we did fixed income securities. Those were basic underlying securities. Now we are doing derivatives. That is to say, a derivative is based on an underlying or more underlying securities. So what we are doing now, futures and forwards are, one kind of derivatives on the underlying securities. And what are the underlying securities we have discussed? Commodities, water, electricity, iron, coal, steel, all of these commodities. Then we have seen futures and forwards, derivatives on foreign exchange. Now, I'm going to offer you a fact, and I'd like you to think about it a little bit. What we do not see is futures and forwards markets that are very heavily on equities. Okay, one more thing I forgot to mention. Sorry, who mentioned capital as an input into production of steel? Who said that? Okay, so in particular, debt management is a large part of the input into any company's production function. So going into the future, looking into the future, a company would also like to manage its risk by understanding what money is going to cost in the future in terms of interest rates. So as a result, we also see a pretty active forwards and futures markets in money. So they're on T-bills, for instance. We see lots of forwards and futures transactions. So as I mentioned, we, however, do not see a lot of forwards and futures on equities, with equities as the underlying securities. However, and we'll see later, we do see a lot of options on equities, but we don't see futures and forwards. And this is the idea of, we will see, let me kind of, the difference between a future and forward on one hand and options on the other. A future and forward, you have the right and the obligation. So Gail, if you and I sign a futures contract where you have to provide me Great British pounds at $1.36 in 6 months' time, if that's the future we agree on, that's a forward we agree on, then you have the right and the obligation to sell that to me, and I have the right and the obligation to buy it. In options, you have the right but not the obligation. So there is a different kind of risk management and speculation that happens in options. But in futures and forwards, it's much simpler. What we'll see is called a linear derivative. You have the right and the obligation. It's a pure risk management tool that you have. So once again, my statement is we don't see a whole lot of forwards and futures written on equities relative to all the other things we have discussed: commodities, foreign exchange, fixed income securities, and so on. Hong Sheng Lin, you have been kind of quiet. Let's see if you want to try to walk us through it.
Hi.
Hi.
Sorry, I didn't hear questions.
Okay, Xingxia?
Yeah.
Yeah. Walk us through why we don't see, why you think it might be the case, given everything we have discussed, between why there is not a lot of forwards and futures written on equities.
Is that because it takes some time to convert to cash or make something liquid?
Okay, good, good. Continue. So you're saying an equity is not a direct cash equivalent.
Correct.
Right, as opposed to a T-bill, which is a direct cash equivalent. All right, who wants to continue with this? That's exactly the idea, but let's try to develop that. Very good, Shing. Let's try to develop that a little further. Who wants to volunteer? This is very high class participation points here. It's a very important idea. Think about this. Equity is when you buy equity, you are buying a partnership, buying a proportion of a firm. Okay.
Sir,
Who's this? I can't
it's
hear
Jane. It's Jane. It's
you.
Jane Zhang.
Okay, hang on.
Yeah. You're saying that if we buy the equity, actually it's gonna be buy a stock, right? We can, and the stock price is already a future. If the stock price rise in the later, so we're gonna gain the money.
Okay.
And also we can short sell the stock if we believe the stock will goes down. This is how we work in the equity. So
Okay.
if we buy the option, if we sign an option, it means that we believe that the stock will goes up. So we lock the risk. But actually, when we buy the equities, we would like to earn the money, right?
Okay, Gail?
Yes.
All right, walk us through what exactly does a security do for you? Let's say you are a consumer or you are a producer. Is the price of equity a direct input into your consumption function or a production function?
The production function.
Yes. So is it a direct input into your production function? How?
Because it would be, it would basically dictate how much you're able to produce.
How? Your equity is, you own equity in IBM. How does that affect your production function, your consumption function, or IBM's production function? Except, as Shing mentioned, if you are able to convert the equity into cash, and that is a direct, the conversion of the equity into cash becomes a direct input into your consumption function. But in terms of the production function, is equity of IBM a direct input into any production function?
No, not directly, because the equity is used to get the capital.
Right. So equity is only an input, is an indirect input only through its conversion into cash. And in particular, it is not a direct input into production or consumption functions. And therefore, managing its price 6 months from now is not an important part of risk management. And it's far less important for risk management than the prices of iron ore, of water, of electricity, of coal, and of foreign exchange, and of money. All of those are direct inputs, and managing the risk over the next 6 months or 6 months from now through forwards and futures is a very important part of the risk management for producers and consumers. So as a result, we see very active forwards and futures in commodities, in foreign exchange, in fixed income securities. But because of the reasons I just mentioned, we don't see an active market for equities, rather forwards and futures on equities. Okay, any questions? So there's been a lot of consolidation, and I'm going to, you should look through it in the future. So you have, the NYMEX and COMEX combined in 1994, CME and CBOT combined in 2007, CME and NYMEX combined in 2008. I mean, there's just so many abbreviations, it's just impossible to even keep track of. Then you have the Eurex, Euronext, LIFA, NYSE, Euronext. I mean, it's just a crazy amount of. So please look at this website that I've sent you, CME Group International. It will give you a very good history of all of these things. So if you are interested in the institutional nature of all these things, so that's there in emerging markets as well. There's BM and Bovespa in 2008. That's in Brazil, where futures and forwards are actively traded. For those of you who are interested, the Hong Kong Exchange also has an active market in futures and forwards. Now, so those are all until 1970s. The assets underlying futures was typically a commodity like wheat, gold, oil. In 1972, the first financial futures, like currency futures, as we discussed, and then interest rate futures in the 1970s. And then we have a lot of stock index futures, not direct equities, but stock indexes, because those are actually strong inputs into, so just let's finish this idea. So indices are often used as benchmarks, for instance, for compensation of executives, or for charging of mortgage rates and so on. So it is in stock index, stock indices are often inputs. So therefore, it's not surprising that there are markets, futures and forwards markets on indices as well. But once again, very little action in equities. So in 1972, as we saw, we had the financial futures first started trading. So, so if you look at how 1972, since then, how things have changed, just until 1976, there were, in 1976, about 1/10 of a million financial futures contracts. By 1990, it was 114 million futures were in financial markets, on financial security, underlying securities. 1976, the all futures was 18.9 million contracts. And only 0.13 million of those were in financial securities. So 18.9 million increased to 154.23 million. So that just a number of contracts in futures increased by explosively from 1976 to 1990, but financial futures, forwards and futures increased much more dramatically. So futures were increasing, but financial futures increased significantly more. So to the point that while it was financial futures were less than 1% of total numbers of contracts. Now, these are not dollar figures. These are contracts in just a number of contracts. Went from, in 1976, less than 1% of all futures and forwards contracts were financial futures and forwards. By 1990, that number had gone up to 73%. What are the top 15 futures contracts worldwide? So, so euro dollar, this is in 2008. So this is kind of slightly dated numbers. One of the things that I'll, because of this current situation of the coronavirus, because the Hopkins campus is closed, I have not been able to update a lot of the data sets. So a lot of the data sets that we'll see, that I'll show you today, are somewhat older data. And I tried to update them with more recent data, but it's particularly for commodities and futures and forwards data. Words is not particularly good. They're available on Bloomberg, and Bloomberg is actually available only on campus. So I was not able to, because of this coronavirus, because campus is shut down, I was not able to update many of the data. So some of the work files I'll show you are with somewhat older data, which is not my preferred way of working, but it is what it is, not much we can do. I'm sorry about that. So these are the top 15 futures contracts worldwide. So as you can see, the euro-dollar contract, which is the underlying is interest rate. So you have a volume of 356 million units. And then you have the E-mini S&P 500. Once it's underlying, it's not actually equity, it's an equity index. And so on. The 10-year treasury note, as you can see, there's a 154 million transaction, 10-year treasury note. E-mini NASDAQ 100, which is an equity index, not individual equity, equity index, traded on the CME for 53 million. So please look at these slides to get a sense of what the top. Okay. So having said all of this, what the heck is a forward? Okay, it's a building block of most derivatives. Forwards are really thousands of years old. So a forward contract is a bilateral agreement between two counterparties. A buyer, or we say, as we have talked about this a number of times, is where it's taking the long position. A buyer is said to have a long position. A seller takes a short position to trade in a specified quantity, okay, of a specified good, that's called the underlying, at a specified price, which is called the delivery price, on a specified date, the maturity date. Okay, so it is a bilateral agreement to trade. Once again, it is the right and the obligation. So let's take an example. Let me see who hasn't spoken in a while. Okay, Yi Do. Can you hear me? All right. So if you and I agree on the following forward, that I will buy 1,000 units of 10-year T-bills at 5% coupon a year from now. That's a forward you and I have agreed to do. That's a forward. So I've agreed to buy. What are your obligations here? What do you have to do?
Well, I have to, I'm sorry, I had to deliver the what? The forward is about what?
A 10-year T-bills with 5% coupon.
Oh, okay. 10-year T-bills with 5% coupon. Well, what I need to do is to sell you
Is there something missing here? What have we not specified?
The time point is.
We haven't specified the price. The forward, for a forward contract to be complete, we need the identity of the buyer and the seller. I'm the buyer, you're the seller. Trade in a specified quantity, 1,000 units. Specified good, which is the 10-year T-bill with 5% coupon. And maturity date, which is a year from now, and the delivery price. All right. So let's say we agreed on the delivery price of 99 instead. So at below premium, 99. Okay. 100 is premium.
99.
99. All right. So then, as you started saying, you are required to deliver. Okay.
Deliver the 10-year T-bill at the price 99 after a year.
Correct. Very good. Now, if at that point the price is, the going price is 95.
Mhm.
If at that point, a year from now, now that's an ex ante product that we have made, agreement we have made. Year from now, whether you like it or not, you have to deliver. Similarly, whether I like it or not, I have agreed to buy from you a year from now. So I'm I've agreed to buy, I'm the long position.
Long position.
You are the short position. I have agreed to, you have agreed to sell, to deliver, as you very correctly pointed out. I have agreed to buy the 10-year T-bill note at 5% coupon at $99 per unit per currency a year from now. Okay, so that's our agreement. We have to do it a year from now when it comes. Today is the 31st of March 2020, and on March 31st 2021 we have to fulfill that contract. If you don't fulfill that contract, I will take you to court and force you to pay. Right? So that's the forward agreement. It will be enforced by litigation or through other means. Okay, now who wants to say, what if, all right, Kai Shu, if the price a year from now, on March 31st, 2020, the price of one 10-year T-bill with 5% coupon is $95, then please tell us what the profit or loss of the long position is and the short position is.
The loss of the buy position should be $5.
Sorry, whose?
The long position.
The long position. So I'm the buyer.
Uh-huh.
I have agreed to, okay. Why is it $5?
Did I need to consider the discount rate? I don't think so.
No, we're just saying a year from now, we are now in 2021, March 31st. I have agreed to buy, once again, 1,000 units of the 10-year T-bill with 5% coupon at $99 per security on March 31st, 2021. I have agreed to do that today, March 31st, 2020. So a year from now, on March 31st, 2021, we are now in March 31st, 2021, and we observe that the price in the market is $95 for that particular security. What are the profits and losses to the long position and the short position?
So the long position will pay 1,000 plus 5%. That should be $50. Which means the buyer, I mean, you just need to pay the $50. So your profit will be 95
okay.
minus 50.
Okay. So does somebody agree with it, disagree with it?
Can I answer this question?
Who is this? Could you?
This is Haihua.
Okay, Haihua, go for it.
For the long position, maybe $4 because 99 minus 94. Is that right?
Ah, that's awesome. That's absolutely awesome, Haihua. Wonderful, wonderful. Excellent. Awesome. Everybody with me? So I have agreed to buy at 99. But when we get to that point, March 31st, 2021, the price is 95. I could have bought at 95, but I didn't know, right? That's the thing, you know, in this case, my bet did not work out and I ended up exposed, losing instead of being able to buy that exactly same thing at $95, I'm having to pay $99. And therefore my loss is 99 minus 95 times the number of quantities, number of units. Very good. So let's finish the thing. So how much is the sellers, the short positions loss or profit, Haiwa?
The loss position is the opposite side, so it get $4.
Yes. So
from the transaction.
Right. Very good. So the seller, the long position, makes 99 minus 95. That's $4 times 1,000 units. That's the profit of the long position. Awesome. That's a great thing about futures and forward. This is a zero-sum game. Because this is just an agreement between two parties. Whatever the long position's gain is exactly the short position's loss, and vice versa, right? Once we take that into account, then so that is the payoff: future price minus agreed price times quantity. That's the profit, right, of the seller. But that's an uncertain outcome that we don't know, because that is going to be realized a year from now. For us to understand that today, we'll have to take an expectation and all that. Hold that thought. We will get to the mathematics of that in a very short while. So thank you all very much for this. So let's just quickly, so Gail, this is exactly what I was talking to you about. So why don't you all read this, and we will go on to do some more things. Okay. But why would that's from the petrol, the airline company's perspective. Why would somebody be on the other side of it? So from there is the exposure to risk. Risk return comes only with risk, right? So so there is somebody with a higher tolerance for risk who is on the other side of the transaction, who is actually monetizing the risk. We call it speculation. It's an ugly word, and particularly in left-wing circles, but that's how it is. So read this, please. Okay. Okay. We'll talk about this. Well, you've already seen this. We will. All right. This is an example of what we discussed earlier. Another example, but using foreign exchange markets. Okay, so you see how the example with that Haihua so correctly pointed out the profits and losses too. Okay, Haihua, you see how this works with foreign exchange, right? Exactly the same idea that you walked us through. Okay, with this is the futures and forwards are actually quite straightforward. They're linear, as we'll see in a short while. It's calculating the profit and loss for any future or any forward is very, very straightforward. It's just this price that you end up paying minus what you agreed on times quantity. But of course, you don't know that when you're signing the forward. The idea is to, that's why you pay a price for it and so on. All right, so as I said, you don't really have, it's not very common to have forwards written on equities, but it's entirely possible. So let's not rule it out. So, so think about this. Once again, I need to, because if you understand forwards and futures, it will be so much easier to understand the much more complicated derivatives such as options. And then we'll go on to do something called warrants, which are even more complicated. Now, why are we spending so much time on this? Because today's financial markets, most investments, most risk management is actually through derivatives rather than direct transactions in the underlyings. Okay, so this is absolutely critical for you to kind of really be able to feel what these derivatives are. So you, let's say we have agreed to buy Microsoft stock at a future price equal to $100 at a maturity date, cap T. S T denote price of MSFT at date T. So let's say the time T price ST turns out to be $70. Then, as you very correctly pointed out, then the price is $70. Then the person who has agreed to buy at 100 looks at it, says, hey, I could have bought at 70. Instead of that, I'm having to pay $100. So I'm losing $30. Short, on the other hand, who has agreed to sell, going market is $70, but is able to sell to the long person at $30. Sorry, at $100. So they're making a profit immediately of $30 per unit. All right. So similarly, if the price of Microsoft at maturity is $80, then the long side of the transaction loses $20 per unit per share, and the short side of the transaction gains $20 per share. If the price is $90, then similarly, the long side of the transaction loses $10 and the short side of the transaction gains $10. If it is 100, what happens if it's 100?
It's like break even.
Right.
It's like break even.
Yeah, both sides make exactly zero.
Yeah.
Yeah. And now we go to the other side. If the price of Microsoft equity at date cap T is $110, then the long side makes $10. How did we calculate that? ED. Actually, no, ED we have asked, you've spoken. Yu Cheng Zhao. Yes. Walk us through what happens if at date T, the price of Microsoft stock is $110.
$110?
Yes.
Paid off too long. I think the payoff too long will be positive to it will gain the profit of 10 in the long run.
Long run, there is no long run here. This is only about date T.
Sorry, I think the date T is like the maturity date or the
It is the
expiration.
maturity date. Yeah, it's not like the maturity date. It is the maturity date.
Yeah. I see.
Would it be plus 10 because instead of a loss at 100, if you had kept it, sorry, let me put my thoughts together.
Can I ask? Can I answer the question?
Actually, let Gail finish, and then I'll.
Oh, okay. Sorry.
No worries.
Okay, so the plus 10 would have been that you didn't lose the 10. I don't know if that's how to say it.
Okay. Think of through the steps. Okay. So you agreed. So let's make it very simple. Okay. You are, let's say, the long side. Okay. You agreed to buy Microsoft stock at $100 a year from now on March 31st, 2021. I agreed to sell to you Microsoft stock at $100 per share on March 31st, 2021. At that point, we are signing this contract today for a year into the future. At this point, we don't know what Microsoft price will be a year from now. Now, we have now taken a time machine, have gone to the future, and we are now at March 31st, 2021. And we look at the Wall Street Journal and we see that the price of Microsoft stock is $110. You are still required to sell to me Microsoft stock at $100 per share. What is you are the long side. What is your profit or loss? ED. Oh, sorry, who wanted to volunteer? Who was volunteering?
Me, Chen Lu.
Okay, Chen Lu, go.
I think I just earned the $10. Like I'm a buyer and I have I have the profit. I am a buyer. Yes. I am the buyer and I am in the long position. Yes. So I earn the money. I have the profit. It's $10.
Explain to me the profit, please. Explain to me the profit.
Because right now in the market, the stock price is 110, but I have the right to buy it on 100. I can buy it on 100.
Excellent. Wonderful, Chen Lu. So you've agreed and you're required to, when you do options, you'll see you have the right, but not the obligation. In this case, you have the right and the obligation to sell to me at $100. And I am required to buy from you at $100. Mm-hmm. Sorry, I'm required to sell to you at $100. My bad. You're the long side. Okay, let me rephrase this. You are the long side, so you are required to buy from me at $100. I'm required to sell to you at $100. So then when I'm requiring to sell to you at $100, I have to buy it at $110. So I'm losing $10 per unit. And you could buy from the market at $110, but instead you are getting it from me for $100 at $10 lower price. So you are making a profit of $110 minus $100 per unit of Microsoft stock by being on the long side. Okay, so thank you very much. So finally, if the price is at time t is $130, then by exactly the same logic, the long side makes 130 minus 100, and the short side makes a loss of the equivalent amount, $30. So as I was mentioning earlier, forwards are linear derivatives. The profit is very, very straightforward. It is price at maturity, ST, minus the price that we agreed on. So the payoff from the long forward is the green line. The payoff from the short forward is the right line. And just depending on how positive or negative they are, they always have to add up to 0. In particular, they meet at 0 as well. And it's just a very, very straightforward linear calculation of the profits and losses for a forward transaction. Okay, so we've talked about a forwards contract. A futures contract is very similar to a forward contract, but some standardization. So think about this way. Okay, who wants to talk about this? Somebody has their hand up. Okay, all right, Shenyan Chang. Are you there? Can you hear me?
Yes, I can hear you.
Okay, all right, Shenyan. Then what is the difference between private equity and a publicly traded equity?
Could you repeat the question again?
What is the difference between private equity and public equity?
Private equity and public equity. I think it's one can. Let me think about this word. One appear in the market and another one is just a private owned by.
Excellent, excellent, exactly. Both are exactly the same. When you're buying private equity, you are buying a share of a firm. When you're buying public equity, you're buying a share of a firm. In both cases, you're buying a share of a firm, you're buying a share of the upside, you're taking on the exposure to share of the downside, you're buying a share of the firm. The only difference is public equity, you can sell on the market because it's on a publicly traded market, whereas private equity, you can still sell it, but it's not traded on the market. You have to sell through a private transaction, right?
Yes.
Very good. So that's exactly is the difference between a forward and a future. So in order for a private, a private equity can be anything. You can have all kinds of considerations and dramatizations and qualifications for private equity. But when you want it to be traded on a market, it has to have some standardization, right? So in particular, your stock has to be delivered. It has to be, there are requirements. If you don't come through with your agreement, then you can go, you might have to lose all your resources, all your assets, and all of that stuff. There are specified arrangements for how public equity differs from private equity. So that is exactly a forward is any transaction, any private transaction is what we would call a forward. Once that forward is being traded on an exchange, it's called a future. So the buyer-seller interaction, for futures, it's via an exchange. For forwards, it's direct. Contract terms for futures has to be standardized. For forwards, it can be tailored in any which way you want. Unilateral reversal. In futures, all you have to do is to buy a contract on the other side and you can reverse out your contract. For a forward, you can't just back out. You cannot, because there is no market on the other side. It's not like I agreed to deliver something and I say, oops, I don't want to, I'm going to sign a contract on the other side. You can't because there is no such market. Whereas for futures, there's doesn't come for free, does not come for free, but you can do it. So default risk, if any part of the transaction fails to deliver, how is the default risk managed? For futures, it is managed by the exchanges. So as in that movie that we saw, Trading Places, we saw that exchanges have these rules. One of which is all transactions have to be cleared by the close of business. So the default risk, the probability that the one side of the transaction might not be able to fulfill its commitments is borne by the exchange for a future. And for forwards, it's by individual parties. And it can be done through litigation. It can be done through what is often as that collateral. So you have to put up, you understand the idea of collateral, right? So if ED, let's say you and I agreed to a transaction on foreign exchange, let's say. So for you to supply euros to me a year from now at $1.31, and we both agree we put a certain amount of US dollars as collateral. So if any party fails to deliver or buy, if they are unable to meet the terms of the agreement, then that amount will be foregone and taken over by the other party. Okay, so so those are the ways, and these margin accounts, as I mentioned, in exchanges, that's often done is any participant in an exchange has to put up a certain amount of its a percentage of its transactions in order to be a participant. And if it fails to fulfill the commitments, then it loses its margin amount. So so this is the standardization that we talked about. And if you look at the bullet point in bold at the bottom, that is exactly the role of exchange in public equity. Commodities futures contracts, as I mentioned, I'll have to give you some older data here because of the coronavirus situation where Hopkins campus is closed. So I'm unable to access the Bloomberg data, which would have enabled me to give you more up-to-date data. But this is we will have to manage the idea. It's you will still get a sense of how this all works. So we're good. So these commodities futures contracts are pretty big. So aluminum, it's traded in the London Metals Exchange. So each contract is for 25 tons. The approximate US dollar market value is of each contract is about 55,000 US dollars, and so on. Right at the bottom, you see there are these futures markets on petroleum, light sweet crude oil. Each contract is for 1,000 barrels, and at the price of $75 a barrel, this is the approximate market value of $75,000. That's clearly a bit dated because right now the price of petroleum is significantly lower than $75 a barrel. Okay, so commodities futures, contracts, financial futures contracts. You can see you have treasury bonds, 10-year treasury notes, US treasury bills, the index, the S&P 500 index, the Dow Jones index, the British pound, the euro. And so the financial futures are in fixed income securities, in equity indices, in foreign exchange, but not that strong in individual equities for the purposes we discussed earlier. Any questions? There are also some these mini futures contracts. As you can see, each contract is much less expensive, and it enables smaller participants to participate in to buy or sell these contracts as well. They're called the minis. Now, one thing you should keep in mind, this financial futures contracts, let's say the top one, each contract is size of $100,000 US treasury bond, but given today's democratization, there are contracts that are placed on top of these. So you have the underlying security, which is a US treasury, then you have a future on top of it, and then you can have a market on top of that, which allows you to invest in a fraction of that if you so desire. So you can have a mutual fund which invests in a future on the US Treasury bonds. So which allows us to actually buy fractions of these securities at at a price, of course, at a cost. All right, I'll let you quickly look at this, and we will move on to some more stuff. Futures contracts are often, as I said, they have to be standardized. So it's the corn futures are traded on the Chicago Board of Trade, the CBOT. The contract months, and for historical reasons, the contract months are only for March, May, July, September, and December. Each contract is for 5,000 bushels, and let's say the quality is number 2 yellow corn. Now the delivery alternative, even though it is number 2 yellow corn, the delivery alternatives is, the standardization says you can deliver number 1 or number 3 yellow as well. These are different qualities of corn. If you deliver number 1, then the short position receives 1.5 cents per bushel more than contract price. If number 3 is delivered, then short position receives 1.5 cents per bushel less than contract price. These are the standardizations that take place. Now, on the other hand, if you write a forward contract, you could write it that only on number 2 yellow corn. So you can do that, but corn futures contracts, as they are standardized in the Chicago Board of Trade, allows these delivery alternatives, which is how these are standardized. And the reason is quite straightforward. You know, with commodities, there is so much heterogeneity between different levels, different qualities, different ranges, and so on of commodities. So the standardization will often require us to deliver slight variations, which we don't necessarily have with equities. So with yen futures contracts, they're traded on the Chicago Mercantile Exchange. You can sign contracts going forward until for delivery in March, June, September, and December. Each contract is for 12.5 million yen. Then, you know, a yen is a yen. There is no quality differential. There are no delivery alternatives. You will have to deliver on those. Now, this is the thing that gets pretty interesting with the T-bond futures contracts. It's traded on the Chicago Board of Trade. The contracts are written for delivery in March, June, September, and December. Each contract is for $100,000 in face value of US Treasury bonds. Quality alternatives. Quality is, let's say, a coupon of 6%, must have at least 15 years of maturity to our first call. Okay, but it provides for delivery alternatives. Any other coupon can be delivered, but the cash flows will be adjusted at the coupon rate to obtain a conversion factor. Okay, it provides for delivery alternatives for the standard T-bond futures contract traded on the Chicago Board of Trade. It can obviously be different depending on different exchanges or different coupons, different bilateral agreements that you can write for forwards, even if they're not standardized. I'm going to, so please,
Hey, Professor, a quick question. So who would buy the T-bond future? I mean, since the future has a like fixed benefits or like interest repayment, which means the expected returns should be somehow fixed.
Why? We have taught the yield can be different. Remember, that's what we did in the previous week. Depending on the price, the yield is quite different.
That's right.
Yeah, I mean, the coupon rate might be fixed, but the yield rate is quite different, depends on the price. Yeah?
Cool.
Okay. That's a very good question. Let's move on. So there are, this, as I mentioned to you, this course of mine is quite self-sufficient. You really need to read the slides more than your textbooks or anything, because there's much more detail in the slides than I'm going to cover in classes, or you're going to be tested on your exams. So, so right now, so there are lots of slides that I skipped over. But please do read them for your benefit. And as I mentioned before, you should think of my slides as something to print out and put on your desk for future references. What I'm going to cover in class are going to be a subset of those. So I'm moving to slide 59 and kind of walk us through some of the simple mathematics of this all. So notations, S naught is the current price of the underlying asset. And we're going to stick with these notations for the rest of the course as well. So it's important for us to all be on board. So S naught is the current price of the underlying asset. K is the strike price of the derivative, or in the case of futures and forwards, is the price of the transaction that everybody has agreed to. Cap T is the time to expiration of the derivative. S cap T is the price of underlying asset at maturity. RF, or just R, is the nominal risk-free return. Remember, this is very asymmetric. The US federal government can borrow at this rate, but you and I cannot. That's the rate at which the US government can borrow. A very secure firm like IBM can borrow at a higher rate. A less secure firm like Tesla can borrow at an even higher rate. For Warren Buffett can borrow at a higher rate. I can borrow at an even higher rate, and all that. And as we did discuss in the context of fixed income securities, the rate of interest that you can borrow at, the difference between that and the risk-free rate, that's the yield spread, is a function of the default risk. It's determined by the probability that you won't be able to fulfill your commitments. Okay, so remember, so R is the rate at which you can lend to the US government, but that's not the rate at which you can borrow. So it's asymmetric. So for our purposes, we typically use rates for US T-bills of similar maturity. So general principles for any security. So payoff risky for any security, for any asset for any underlying asset for a forward is payoff at the end. Remember, which is one of the things that we discussed. It's perfectly linear. Shenyang, as you can see, the payoff for a long forward is the price of the underlying at time t, ST, minus the price of the forward that you have agreed to, divided by 1 plus R to the cap t. So ST minus K is what you make, let's say for a year from now. If T is 1 year into the future, ST minus K, the numerator is what you're going to make a year from now. Then you discount it to today at the risk-free rate. So the numerator is what you're going to get at a year from now. Discounted to today is what the denominator is. So therefore, for a risk-neutral investor I, the price of a long forward is the expectation of this. Price, remember, is the definition of price is that dollar figure at which you are indifferent between buying, between selling, or holding. That's the definition of a price. So, so for a risk-neutral investor I, the expectation of ST minus K divided by 1 plus R to the T is the price at which you are indifferent between buying, selling, or holding. For just the flip, this is a zero-sum game. So the payoff to the long is exactly the negative of the payoff to the short side. So the payoff for a short forward equals K minus ST at maturity. Discounted to today, we're going to divide it by 1 plus R to the T. And therefore, for risk neutral investor I, the price of a short forward is the expectation of that. If the actual price is higher than that, then you will sell. If the price is lower than that, you will buy. But at that price, you are perfectly indifferent between buying, selling, or holding. Okay, this is something we're going to keep doing. So it's important for you to understand. First of all, it says no riskless arbitrage. Now, one thing that I find, people who really know a little bit, as they say in English, a little knowledge is a dangerous thing. There are people who will make the stupid statement that arbitrage is by definition riskless. That's just stupid. What we are saying here is that arbitrage typically has substantial risk to it, and a large part of my research and consulting is on quantifying that arbitrage risk. And but what we are saying here is, if there is no riskless arbitrage, if there is the possibility of riskless arbitrage, then that's not a sustainable situation. Market will not permit a riskless arbitrage. What is arbitrage? Arbitrage is buy low, sell high. You buy at a lower price, sell at a higher price. That is arbitrage. Typically, you take a substantial risk because when you're buying low, you are assuming that the price is going to go high. The price might not go high, the price might go low, in which case you would have lost money. So there's risk involved in arbitrage. So as I said, when people say arbitrage, or some people, idiots, who say arbitrage is by definition riskless, it's stupid. Arbitrage typically is risky, and that's how arbitrageurs work. What this is saying is a riskless arbitrage, when if I guarantee you that you can buy Microsoft stock at 200 and sell at 250 with no risk whatsoever, then that's not a sustainable outcome, because you're going to immediately utilize it. Okay, so a profit opportunity which guarantees net cash inflows with no net cash outflows, that is riskless arbitrage. It's an extreme form of market efficiency when two identical securities trade at different prices. Okay, that is the situation of riskless arbitrage. Okay, the assumption is not that those arbitrage opportunities can never arise, but that riskless arbitrage situation will not persist. So this is, if you see the last bullet point, this is a minimal market rationality condition. If those opportunities can persist, there's nothing you can say. Then all bets are over. It's done. What we are saying is it cannot happen. It's a minimal market condition. So all of derivatives is based on the idea of no riskless arbitrage. Okay, is that clear? Arbitrage opportunities are there. That's how the whole market works. It's all about arbitrage. Arbitrage typically has risk. What we are saying is, anytime you have a situation of no riskless arbitrage, if the same security, it is selling at the same time at two different prices, then somebody can buy at the lower price and sell at the higher price. So that's the riskless arbitrage opportunity is not sustainable. That's the assumption under which we do all our derivatives pricing. Okay. Based on that is the idea of replication. So remember that derivatives payoff is determined by the price of the underlying asset in the way that we discussed earlier. So because it is determined by the price of the underlying asset, it should be in principle to recreate or to replicate derivatives payoffs by directly using the spot asset and cash. Okay, the derivatives payoff is determined by the price of the underlying asset. So taking an underlying asset and cash, we should be able to come up with another security that completely has the same payoff structure as the derivative, and then we use that. So derivative and its replicating portfolio are equivalent. So by the no riskless arbitrage condition that we have talked about, they must have the same cost. So therefore, the value of the derivative is the cost of its replicating portfolio. So all of derivatives will do exactly that. We'll say this is a derivative, and I'll show you in just a minute. This is a way to replicate this particular derivative using underlying and cash, and the cost of the underlying and cash, the replicated portfolio, is the cost of the price of the derivative. That's the idea of replication. And we're kind of moving away from transaction costs, taxes, short sales costs and constraints, and so on. Those are complications that can be added on later, but to keep it simple, this is how we're going to look at it barefoot. Okay, let's go through these calculations to derive futures prices. So consider the following futures contract in November 2019. Buy in December 2020, 1 unit of gold at futures price F. Okay, so what are the payoffs in December 2020? Minus F in USD, because you're going to have to pay F to buy that unit of gold in December 2020. What you're going to get for it is 1 unit of gold. Is that clear? Okay, one small step at a time. Okay, don't rush, don't try to speculate, one small step at a time. Okay, consider the following portfolio in November 2019. Borrow F over 1 plus R today and buy 1 unit of gold. Consider that portfolio. So what are the payoffs for this portfolio? So in December 2020, this F divided by 1 plus R you have borrowed. You have to repay that in December 2020. And remember, we are saying that we are saying we can borrow and sell at that rate of interest R, which is clearly not the case. And we'll see in a second how the actual calculation is different. But under the assumption that the rate of interest is symmetric and the same for everybody, then this F, you have borrowed F divided by 1 plus R today. That will then, you will have to pay back F amount in December 2020. So you will negative F, that's how much you have to pay off. But remember, you have bought that unit of gold in November 2019. So in December 2020, you still have that 1 unit of gold. And this is under the assumption that there are no storage or spoilage costs. The gold, it's very cheap to store or spoil, and it doesn't spoil. Now, those are strong assumptions, and we will see in a short while why that is the case. For instance, storage cost of gold is actually quite high, even though a tiny amount, but you have to pay for security. Sometimes you have to put it in a bank vault, and so on. So storage costs of gold are actually not insignificant. Is there a convenience to holding gold? Yes, there is, because you can borrow money using that as collateral. So there are these assumptions that we're having, that no storage or spoilage costs or growth or convenience, both are actually strong assumptions. But we're doing it under these assumptions, and we'll see in a second what we do when that does not hold. So going back to it, in December, the futures contract has the payoff in December 2020, negative F in US dollars, positive 1 unit of gold. For the portfolio that we just discussed in November 2019, what are the payoffs? Negative F in US dollars, positive 1 unit of gold. So the futures contract and this portfolio have exactly the same payoffs. So this portfolio that we have constructed has exactly the same payoffs as the futures contract we are trying to evaluate, and therefore this portfolio that we have created is our replication portfolio. Therefore, therefore the replication portfolio's cost has to be exactly the price of the future. That's what we're, that's the whole assumption under which any derivatives must be evaluated. So let's kind of go through this table. The gold futures that we're talking at, what is the action at 0? Buy 1 gold futures. And this thing is, one of the things about a futures is you don't have to pay anything to buy a futures. It's all, the payoffs all happen in the future because that's when you're required to follow through on your commitment. We'll see later in options, because you have the right but not the obligation, you actually have to pay upfront to buy that contract. All right, so flows at 0, at time 0 is zeroed when you're buying a gold future. The flows at T are ST minus F. Okay, because you the price at time T is S cap T. That's how much you get for it, but you have to pay F dollars in order to fulfill the commitments of your futures contract. So that's the gold futures. The replication contract is borrow F divided by 1 plus R to the T and buy 1 unit of gold. That's the action at time 0. What are the flows at 0? So for the first security, the first part of it, when you're borrowing F divided by 1 plus RT, the flows at 0 is plus F, that's what's coming to you, plus F divided by 1 plus RT. And you're buying 1 unit of gold. So you're having to buy it at S0, which is the price of the gold at time 0. That is an outflow from you. So the inflow is F divided by 1 plus R to the T. The outflow is negative S0. What is the total outflow? Plus F divided by 1 plus R to the T minus S0. What is the flows at T? Negative F plus T, ST minus F. All right, so to summarize, the gold futures, the flows at T at ST minus F. For the replication portfolio, the flows at T are exactly ST minus F. That's why they're replication portfolios. And therefore, however, at 0, the flows for the gold futures 0, exactly equal to 0. For the replication portfolio is F divided by 1 plus R to the T minus S0. Because they are exactly the same replication, this number F divided by 1 plus R to the T minus S0 has to be equal to the flows of the gold futures at time T today. That's the idea, follows from no riskless arbitrage, that the flows at time 0 of these two identical equivalent portfolios have to be equal. They're not identical, they're equivalent. They're replication portfolios have to be the same. So they must cost the same today. That is 0 equals plus F divided by 1 plus RT minus S0. This is the interesting thing, irrespective of the asymmetric information or attitude to risk. So far in this conversation, we have not talked about asymmetric information or about risk aversion parameters, okay? Because that does not matter here. All that matters is that the markets be efficient in the sense of not allowing for riskless arbitrage. We have also assumed that borrowing and lending can be done at the riskless rate R, and that there are no taxation or transaction cost constraints or short sales costs and constraints. Okay, so we're not making any assumptions on asymmetric information or attitude to risk. And in particular, if this equality 0 equals F divided by 1 plus R to the T minus S0 does not hold, then there will be a riskless arbitrage trade available. So equating those, we get S0 equals F divided by 1 plus R to the T. Remember, take this 0 equals this equation. Equating those, we get S0 equals F divided by 1 plus R to the T. Solving for F equals 1 plus R to the T times S0. Okay, so how is this working? This is working from the idea that the difference between spot and futures prices account for carrying cost of buying gold today. Okay, so it's the time value of money, cost of tying up your funds. I'm going to go through a bunch of different work files, but in practice, we must sometimes adjust that spot futures parity relationship to account for other factors that affect carrying cost of commodities. So if an asset has a dividend yield of D, a convenience yield of Y, a storage or a spoilage cost of U, then futures price has to be adjusted for this. So instead of just being futures price being 1 plus R to the TS0, you have to adjust the R with the U, which is the storage or spoilage cost. Then you have to subtract the convenience yield and the dividend yield to do the futures relationship with current stock price is given this. So this future price, earlier we said, if you did not have these dividend yield of D and the convenience yield of Y, the storage spoilage cost of U, then it is, the futures price would be always greater than S naught. But in real life, what we see is the future price is greater than current spot price if R, which is the rate of interest, plus U, which is the storage spoilage cost, is greater than Y, which is the convenience yield, plus D, and go back otherwise. Let me quickly a futures market is in backwardation if futures prices are below spot. Okay, so we saw earlier when future price is above spot and when it is below spot, and it's called to be in backwardation if future prices are below spot. It's contango if future prices are above spot. If there is a positive cost of carry, then futures will be above spot, markets will be in contango, but it varies. Let me then go back to 67, and I'm actually going to start with the last spreadsheet first because it's about just simple data. As I mentioned to you, I've not been able to update the data because the campus is shut, and these commodity data are only available via Bloomberg terminals, and that's not available to me right now. So as a result, lot of the data I'm showing you are only, a few months old. So here what I plot from 2014 to the latest I have data for. Okay, can you see my Excel spreadsheet?
Yes.
All right, so as you can see, there is the data here are the spot price. So that, I have the spot price data, I have futures prices data. They're all from Bloomberg. I put them all together using VLOOKUP. As you can see, I've done them through VLOOKUP. Spot price for each date, I plot the spot price and the futures prices for a particular kind of petroleum. This is WTI Cushing crude oil spot, WTI Cushing. I've taken that crude oil, I've taken the spot and the futures prices for those and plotted, and then if we do the diagram, the chart looks like this. Remember, if future is above spot, then it is, that is when it is called to be contango. If future, so here as you can see, right at the leftwards part of the curve, you have future is below spot. This is backwardation. And then we see for a long period, you have the futures prices above spot. This is contango. And then it kind of moves around quite a lot. So this is the thing about oil futures move back and forth a lot. We see a lot of this going on. This is, remember, a spot price is the price of that commodity at that particular point in time. Futures price is an expectation of what that price will be in the future. So in the first few months of 2014, when we see a situation of backwardation, it means that the markets are expecting prices of crude oil to go down in the future. And then we see futures prices, then we see a situation of contango. So going back to it, it is futures price is above spot price. It is in a contango if R plus U greater than Y plus D. So what are the R is the risk is the rate of interest, and U is the storage cost. Now, one of the things to keep in mind for petroleum, storage cost is huge, absolutely huge. So it's not surprising that that R plus U can be pretty high. Why? What is the convenience yield? It's the idea that you can actually borrow money if you have inventories of world petroleum. So there is that convenience yield. Petroleum doesn't expand. It's not like it's a hen that lays eggs. So you don't have, the dividend yield is zero, but you can see that there will be times when the left-hand side will be greater than the right-hand side, and sometimes the right-hand side will be greater than the left-hand side, which is why it is very common for the world petroleum market to move back and forth between backwardation and contango. So let's pause for 5 minutes. It's 11:54. Let's regroup at 12 p.m.